12 and welcome to another YouTube lesson. Today we're going to take a look at finance and processes, and in particular this monitoring and controlling. We've been looking at monitoring and controlling last lesson, and we'll continue to take a look at monitoring and controlling next lesson as well. Today is going to focus mainly on income statements. Last lesson took a look at cash flow statements as a tool, a method to monitor and control. And next lesson, the tool that we'll use to monitor and control a business's finance, we'll be taking a look at balance sheets. Okay, so the use of an income statement, as I said before, is just another way to control a business's finance. It's a process because it's something that a financial manager or a business needs to do in their role. Now, an income statement. This is a summary of a business's revenue and expenses over a set financial period. Usually with an income statement, we see it in the HSC exams, usually. Never take things for granted. Sometimes they change from year to year, but it's an annual thing. And we're looking usually at a financial year. Now there's two other names, just to make it a little bit confusing as they do, two other names for an income statement. It's known as a profit and loss statement. It's also known as a revenue statement. It makes sense. An income statement, you're looking at your income, but then I think you should have expenses, but income statement is what it's called. Profit and loss is the business making a profit or loss. That certainly makes sense too. But that other name is a revenue statement. It does look at how much revenue, sales a business is making, minus COGS and other expenses. Now, there's some important ratios that an income statement enables you to be able to find. They are the net profit ratio, which is net profit ratio equals the net profit part of your income statement divided by the sales part, the top line of your income statement, and then we times it by 100 to get our percent. Higher the better. Higher percent of net profit ratio, the greater net profit compared to sales a business has. That's what you're after. Gross profit ratio, we can use the income statement to also figure out what that is. And the gross profit ratio, just to remind you, is gross profit divided by your sales times 100. Now your gross profit is your sales minus COGS, as your GP, your gross profit, divided by sales, which is the top line. And then again, you're timesing it by that 100 to get that percent. Gross profit should usually be higher in all instances than net profit. If it's not, something's a bit wrong. Now, another ratio that you can find using this income statement is your expense ratio. The expense ratio is your total expenses divided by your sales times that percentage of 100 again. The syllabus doesn't really have that times 100, but we want to get you guys to figure out the percent. All right, so that's why we put in the times 100. All right, now it's also got half the information needed, an income statement, it's got half the information needed for the accounts receivable turnover ratio. So as it provides the sales part of the information for the formula of accounts receivable, that's useful, but you also need to get the accounts receivable figure that's given by a balance sheet. What you will find sometimes is that you might have an income statement or an extract of it or the whole statement. And down the bottom in the notes, you might find that it'll have additional information like the accounts receivable. And therefore, it's asking you to figure out the accounts receivable turnover ratio and usually the next step, which is the amount of days it takes on average to get your accounts receivable paid. And you can figure it out in that way. All right, now, in terms of an income statement, you have to sort of visualize. Don't have anything in front of us at the moment. But whenever I'm answering financial questions, I always have in my mind an income statement, a cash flow statement, or a balance sheet. And I'm sort of thinking, okay, how's it all fit into place? So your balance sheet, you've got, on the left-hand side, you have your assets, current assets and non-current assets. Right-hand side, you've got your liabilities and your owner's equity down the bottom. So I want you to visualize now an income statement and what we've got happening with an income statement. The top line, you have sales. Then you have minus your COGS. Okay. Now, COGS is the cost of goods sold. Remember, it's opening stock plus purchases minus closing stock. Okay, that gives you your gross profits. Let's do this again. Write it out. Sales up the top. Tick. Dude, we've got our sales up the top. Then we have COGS below it, cost of goods sold. Right, so the cost to purchase your goods you're selling. I gave you that formula 2 seconds ago. That equals, there in between it, the gross profit. That's your first set of profits you have. Just raw gross profit, not gross profit ratio. Then you have your gross profit, you minus all your other expenses, okay, and you arrive there at your net profit. And some, real businesses have your net profit before tax, your net profit after tax. And that's just taking, 30% off or 27.5% off at this stage for businesses with under $10 million in turnover. Now, COGS, a little bit more on that, because kids get confused. COGS, all other expenses, what's the difference? COGS is the cost to buy the goods the business is selling, i.e. if it's a canteen buying super dupers, those ice block things, all right, then COGS takes into account the raw cost of buying the super duper, not how much they sell it for, not how much wages are or electricity, none of that stuff. It's just it might cost per super duper $1 to buy, even though they might be selling it for $4, $1. Okay, also in COGS, the cartage is included. That's a delivery cost, but does not take into account electricity, wages, as I said, etc. Now, the other thing to know is all other expenses. There's 3 categories. 1, 2, 3. 3 categories, 3 parts to the expenses that you'll find when you want to know your net profit. That's selling expenses, so costs associated with selling, financial expenses, interest rate loans, those type of things, and administrative expenses. Okay, and the total cost of those 3 things, you add them up, your gross profit minus all that stuff, those additional expenses, and that gives you your net profit. Okay, guys, thank you very much for listening. See you next time.